Good day, everyone, and welcome back to my YouTube channel. Today, we'll be talking about 5 things in Forex. Firstly, we're going to start with what is Forex. A lot of us trade and we don't know what we are really trading, if it's stock, future, or Forex. And secondly, we'll be looking at what is traded in Forex. Thirdly, we will look at when can currencies be traded, why trade foreign currencies, and lastly, the comparison between Forex and stock. But before we get started, I want you to hit the subscribe button and don't forget to turn on the notification bell, and also do like and comment. Thank you. What is Forex? Forex has a lot of meaning, but let's stick to the basics. Forex simply means foreign exchange. I repeat, Forex simply means foreign exchange. Some people call it FX, some call it Forex, some call it spot. Different names. Forex is the largest financial market in the world with a volume of about $2 trillion a day. If you compare that to the New York Stock Exchange trade, which has a volume of about $25 billion per day, you will notice that Forex is actually 3 times the total amount of stock and futures combined. So, whenever you are asked what is Forex, simply say it means foreign exchange. Okay? If that is clear, let's move on to the next chapter. A lot of beginners get confused when they are told that my business is Forex. They wonder, what do you buy? What do you sell? It's pretty easy. The direct answer is money. You trade money. Forex trading is simply the buying of one currency and selling of another. Currencies are traded in pairs. In my next tutorial, I will talk about currency pairs. Make sure you watch that video because it will teach you more about how to trade currencies, where we will be talking about quotes and base. Okay? What we trade in Forex, once again, is money. When can currencies be traded? A lot of traders knows how to analyze a market, both technical analysis and fundamental analysis. They know what a chart means. They know more about Forex, but they don't know the answer is straight when there is high volatility. High volatility comes with low liquidity. That means low liquidity is what brings about high volatility. Currencies with higher volatility will normally move more pips over a certain period than currency with low volatility. Lower liquidity results in more volatile markets. All these things I said means the same thing. I'm just putting it in a way you can understand. Volatility simply means fluctuation in a market or an asset. Okay? So now, for example, a currency pair that is fluctuating between 5 to 10 pips is less volatile than a Forex pair that fluctuates between 50 to 100 pips. If you are in a currency pair that is moving from 5 to 10 pips and you open a trade, and someone else is in a currency pair that is 50 to 100 pips and he opens a trade, he will have more profit. The reason because the higher the volatility, the higher the pips. Okay? But at the same time, if your analysis were not right, you are going to lose more money. Okay? What goes around comes around. It's 50-50. Okay? Liquidity refers to how active a market is. Liquidity is dependent on how many traders are actively trading and the total volume they are trading. So you see, liquidity is so dependent on how many persons are trading at that particular time, and this will affect the volatility of the market. The higher the liquidity, the lower the volatility. And the lower the liquidity, the higher the volatility. Okay? One reason the foreign exchange market is so liquid is because it is tradable 24 hours a day during weekdays. So, this already tells you why you have high volatility and low volatility. Okay? So, the question still remains now I can explain when to trade. We have different times when we can trade in Forex. The best time remains the US London market overlap, which takes place between 8 a.m. to noon EST, Eastern Standard Time. If you're in Nigeria, this time is 1 p.m. to 5 p.m. Okay? It has the heaviest volume of trading and it is the best trading opportunity because market within this time are volatile. Okay? Followed by this is the Tokyo market overlap, which take place between 2 a.m. to 4 a.m. EST. Okay? It is not as volatile as the US London overlap though, but it still offers good opportunities. Okay? So I think as a beginner, the best time you need to trade is either the US London market overlap or the Tokyo market overlap. In the next videos that I'll be doing very soon, I will talk about the best time to trade forex as a topic itself. Okay? So for now, this is just the beginning, right? So let's move on to the next topic. Why trade foreign currencies? So the benefit of trading foreign currencies are there, but just that if you don't know, you don't know. One of the benefit of trading foreign currency, I can ask it as why trade forex? Reason is because one, it has low to free commission. Secondly, there is no fixed lot size. Don't worry, in my forex and terminology section, I will explain all these words. Just follow me. Thirdly, it is a 24-hour market. Number 4, it has good leverage. And 5 on my list is you can have access to mini and micro accounts. Okay? If you don't have enough capital, you can start up with a macro account. All right? So if that is gotten, let's move over to forex versus stock advantage. Now, let's talk about the advantages of forex to stock. Okay? Number 1 on my list is forex is traded 24 hours in a day, meaning it is a non-stop market. Okay? If that is cleared, number 2 on my list is commission-free trading. Forex offers you a little to no commission in trades that you place. Okay? And lastly on my list is forex has instant execution of market order, unlike stock. Okay? So these are the advantages of forex over stock. For now, maybe in other lessons I will tell you more about this. So if you have any question, please drop it on the comment box, and please don't forget to subscribe to my channel and turn on the notification bell, and also do like. All right, if you have any question relating anything at all, just drop it in the comment box. I will do a video on it. Okay.